Hey there, my name is Edwina Dixon and welcome back to my channel. We talk about finance and mortgages and property all around Australia. Today we're actually going to be discussing the mortgage cliff. You've probably heard about this in the news, and today we're going to break down what it is, how you can prepare for it, and whether it's even going to affect you. So let's dive in. Before we jump in, let me explain who I am and perhaps why you should listen to what I have to say. As I said, my name's Edwina Dixon and I'm a mortgage and finance professional. I've been in the industry for over a decade. I've won numerous industry awards for excellence in finance, and I really have a great understanding of the way that mortgages work since I've helped thousands of Australians actually get a mortgage, but also, more importantly, pay their mortgage off a lot faster. So in total, as at today, we've saved our clients over $10 million in interest. That's a lot of money, and I can help you do the same thing. So today we're actually going to be talking about the mortgage cliff. It may be something that you're actually about to hit, or perhaps it's missed you completely. Let's hope it has. But either way, let's dive in and really look at what is the mortgage cliff. Well, during COVID-19, what the central banks around the world actually did to help stimulate the economy and to be able to help people get through what nobody knew was going to happen, especially financially, was they reduced interest rates. So the Reserve Bank of Australia, or the RBA, they actually dropped the cash rate. This meant that the cost of money for banks to be able to lend to you and I actually reduced. The flow-on effect of that became that people were able to then get really low fixed home loans. Now, here in Australia, the RBA actually reached a cash rate of 0.1%. That's incredibly low. It then meant that during that particular point in time, a lot of people were able to get fixed interest rates for 2, 3, 4, 5 years, and they were very low as well. A lot of those fixed rates dropped down to just under a 2% interest rate. Now, this would then mean that with an interest rate of 2%, if you had a $700,000 home loan, your repayments were then likely to be $2,967. That's pretty low. But now what's happening is those fixed rates are actually expiring. And those people that had that really low fixed rate are about to have a much higher interest rate. Those interest rates are now going to jump up to somewhere around 6%. Now, if we assume worst case scenario, your particular fixed rate comes out of its fixed expiry period, say middle of next year, interest rates at that point might mean that your variable interest rate is 6.6%. If we assume that, that would then mean that a $700,000 home loan would have a monthly repayment of $4,770 per month. That's a really big difference. That's an increase of over $1,800 a month. Now, the question becomes, where are you getting that money from to make those additional repayments? But let's set that aside for the moment and focus on the mortgage cliff. This is what has been given the term the mortgage cliff, where all of a sudden your interest rate has gone from, say, 2% all the way up to 6.6% or 6%. That's a huge amount. That's a 4% increase in interest rate. And that's purely because the economy is having to readjust after COVID. So to say it really simply, a mortgage cliff is where somebody has had a really low interest rate and they're about to very quickly jump to an incredibly high interest rate. It's one day they've got an interest rate of 2%, the next day they've got an interest rate of 6%. That massive jump, that is called the mortgage cliff. So you're probably watching this video for one of three reasons. Either you've just experienced the mortgage cliff and you're really wondering, what do I do? What happens now? How can I actually get ahead? Or number two, perhaps you think you're about to actually experience this mortgage cliff. And again, you want to know what to do. How can you prepare now for when that happens? Or number 3, you're actually not sure. You're not sure if you're going to be experiencing that mortgage cliff, and you want to understand how can you check to see whether you are. So let's actually look at each of these different scenarios. Feel free to scroll through and get to the section that actually suits you and your situation best. So if you've just experienced the mortgage cliff, don't be alarmed. There are a lot of people that are going to be going through this situation. All up, there's an estimated $270 billion worth of home loans that will be coming out of a fixed rate period. And every single person that has a home loan that's part of that $270 billion will be experiencing the exact same thing as you. Now, this is important because it means that the banks themselves are hyper aware that the flow-on effect is that they need to make sure people are able to continue to afford their repayments on their mortgage. If you have experienced the mortgage cliff so far, here are 5 different things that you can actually do to make sure that you're getting ahead and preparing, and that you're not falling behind on your mortgage repayments, and you're not losing too much in terms of your savings buffer by having to use savings to make additional contributions to your mortgage repayments. So here are the 5 things that you actually want to look at if you have come off a mortgage cliff and you're starting to really think about, where do I go in the future? The first one is going to be one that you've probably heard all the time, and you don't really like the answer because you don't do it, but you should. This is a budget. I know it almost seems like a dirty word, but it actually isn't. A budget will help you to actually make sure that you're staying on track. There are lots of different methods for how to actually budget. However, on our website, in the link below, you'll find a budget that's specifically designed if you have a mortgage and you need to make sure that you're preparing for the future. It will allow you to look at where are you now, but also what adjustments can you actually make to expenses, to income, as well as to other debts, to actually be able to continue to save, because that is important, but also to make sure that you can keep up with those repayments as well, especially if they do increase further. Number 2 is to contact your mortgage broker. Now, as a mortgage broker, I am a little bit biased, but we do understand that there are a lot of different things that you can do to improve your finances, and it is different for every single person. Your financial situation is different from your neighbors, from your friends, from your parents, from anybody else that you know. Everybody's finances are different and they should be treated as such. And this is why contacting your broker, especially if you've already got a really good relationship with your mortgage broker, will actually help you, because they'll help to guide you through and to build a plan specific for you and your situation. Your other option is to negotiate your rate. Now, here you can actually call up your bank directly, but in doing so, not only do you want to call them up and say, "Hey bank, how's it going? Can I have a lower rate?" Because the odds are they'll say no. Keep in mind, they're there to make billions of dollars in profit every year. You want to actually call them up and say, "Hey, I've seen that your competitor is offering a much lower interest rate. I'd like you to apply that interest rate to my home loan, or I'm going to take my business over to them and get their lower rate." Odds are, if you haven't done this in the last 12 months, or your broker hasn't done this in the last 12 months, then you're going to get a lower rate. This is part of the loyalty tax that is often spoken about, but we'll talk about that in another video. Another option that you've got is consolidating debts. Now, this is where if you've got multiple debts, so you've got your mortgage, you've got a personal loan, you've got a car loan, you've got credit cards, all of these different things. If you have more debts than just your mortgage, you then have the option to actually consolidate those debts. That means taking all of those debts, combining them down into one with one lower repayment. Part of doing that will actually allow you to then restructure all of those debts so that your cash flow works better for you, it works better for budgeting, and it will help you to actually then hopefully save a little bit more. And then the last option you've got is refinancing. Now, refinancing can mean that you can get a lower rate and at the same time potentially actually extend out that loan term back to 30 years. So your loan term might have started at 30 years, you've had 2 years, you now have a loan term of 28 years. Depending on, again, your personal financial situation, you may find that actually you're able to refinance to a lower rate with a different lender for 28 years. So you're not paying a whole bunch extra in interest, but if you're not able to service that, and if the bank kind of says, sorry, you can't do it from their calculations, then you can extend it out for 30 years again. And that may be enough to actually then allow you to refinance it for a much lower interest rate than perhaps what you're currently getting if you've already come off that mortgage cliff. Refinancing to get the loan term extended out can be really advantageous for you. Refinancing can be done for lots of different reasons. It doesn't have to just be for a lower rate. You might have a loan that you've had for say 10 years, and it means that your repayments will be based on the remaining amount of time you have left on that loan term. So if you've started with a 30-year loan, you've had it for 10 years, you still have 20 years remaining. But what about if you refinance that loan and instead of refinancing it for 20 years, you refinanced it for 30 years? The loan amount hasn't changed, but what has changed will be your repayments because you've given more time by the bank to be able to repay the exact same amount of money. Yes, you're going to pay more in interest, but in terms of cash flow, your cash flow will actually improve because you'll have more in your pocket. In refinancing and changing that loan term, keep in mind two things. You are going to be paying more in interest over the life of the loan. That's the 30 years. But the other thing will be that you want to keep in mind is, on average, Australians actually sell their house every 6 to 7 years. So you're not going to spend 30 years in the exact same house. Do you know anybody that spent 30 years in the exact same house? Probably not many people. So keep that in mind when you're actually just trying to work out, if you refinance, what's the best way to go about it? Are you looking for cash flow? Because if you're looking for cash flow, extending your loan term might be the best way to go. But if you're looking to pay it off as fast as possible, keeping the loan term where it is may be a better option. So if you haven't just experienced the mortgage cliff, then maybe you're the second person that's watching this video. Perhaps you're about to experience the mortgage cliff. If this is you, here are 3 different things that I want you to start doing now, today. As soon as you finish watching this video, and I even want you to pause, grab a pen or your phone and take notes, because this is important. You have the opportunity right now to actually prepare for what is coming. There's 3 simple things that you can do. And I can't stress it enough. It is important for you to actually take action now because it will help you in the future. Number 1, you want to get really clear on your budget. This means I want you to jump onto that link, grab our budget, and I want you to actually make sure that you're going through it. Have a look at it. What are you spending money on? Do you need to get rid of certain subscriptions? Do you actually need Netflix? Because this is YouTube. You could just use this. Is it that you actually are spending too much money going out with friends? Now, this is where, as you've gotten pay rises, all of a sudden the amount of spending that you're doing has increased. Was it a case of back in the day you used to get together with friends and you'd all bring dinner and you'd hang out and you'd chat? But now, instead, what you're doing is you're going out for dinner, you're going out for cocktails, and you're dropping, $150 every single time you catch up with friends. Make a shift, make a change. Now's the time where you really want to be focusing on what clearly is your budget. If you've got a partner, sit down with them. If they hate budgets and they find them really squirmy, like my husband, then find another way. Maybe it's a case of going, okay, here's how much you can spend every week. Here's how much I can spend every week. You want to get really clear so that you're actually increasing the amount that you're setting aside and you're building up your savings buffer as much as possible. The second thing that I want you to do is to take proactive action. Here's where I want you to work out, what is your repayment right now per month? What is your repayment going to be when it hits 6%? And again, jump on our calculator. There are links below. You then want to grab the difference. So if it's a case of all of a sudden your repayments per month are going to increase by $1,800, what I want you to do right now is start putting $1,800 aside into your savings account. So you're starting to live as though that increase has already happened. There's a couple of things that are going to happen here. It's going to change the way that you think about the money coming into your account every single month. And it's also going to increase what you've got as your savings buffer. So when that mortgage cliff does come, you'll already be prepared. You will have already taken full advantage of the really low interest rate that you're currently on. The next thing I want you to do is I want you actually to speak to a professional. Speak to a mortgage broker, reach out to a trusted advisor, get in touch with us. Either way, find a mortgage broker that's going to help you to understand what your options are when you come out of that fixed rate. If you know the specific date that your fixed rate ends, that's a really great time. It means that 2 months out, you can start chatting to your mortgage broker. They will actually then be able to help you. If it's a case of refinancing, what they should be able to do is actually make sure that as soon as that fixed rate expires, the next day you are with a whole new lender at a much lower rate than what you would have got if you stayed with your current lender. But you want to keep the fixed rate sitting in place for as long as possible so that you are getting the full advantage of that ridiculously low interest rate that you're on. If you have been watching this video and you are not sure whether you're going to experience the mortgage cliff, well, here's how you work it out. Open up your banking, whatever banking app you've got, whoever you're with. If it's on your phone, whether it's online banking, or whether you prefer to give them a call, up to you. Either way, I want you to actually look at what the bank has sent you most recently. As part of the app or on a statement, it will actually tell you what the interest rate is. If you have seen over the last 4 months that your interest rate has changed, and if you look on a bank statement, what you'll see is a little line that says your interest rate is now 4.35%. And then about a month later, you'll see your interest rate is now 5.2%, whatever those numbers are. If over the last 4 months, you've seen in your statements that interest rate change and go up, you have a variable interest rate. This means you aren't going to experience the mortgage cliff. But if you are one of the unfortunate people, like a lady I spoke to this morning, who's sitting on 8% interest because she's on a variable, she's never asked her bank for a rate reduction, and she's never extended out the loan term. She is paying an enormous amount in interest every single month. What I want you to do is I want you to open up your bank account, check what is your interest rate as at today. What is it right now? And then I want you to get in touch with the bank and I want you to ask for a rate reduction. Say to them, hey, I saw your competitor. They're getting a lower interest rate. I want you to apply that interest rate to my loan today, or I am going elsewhere. Do it. You will save money. It's one of the things that will save you a lot of money over the life of the loan. Now that is if you have a variable interest rate and you've seen that interest rate changing over the last few months when you look at your bank statements. If, however, you pull up your bank statements and on your mortgage loan statements, the interest rate hasn't changed at all in the last, say, 6 months, you are on a fixed interest rate. And if you are on a fixed interest rate, it then means that at some point in the future, your interest rate is going to jump, and it will jump high and fast. If this is you, call up your bank, and ask them, when does my fixed interest rate expire? You might be able to look on the app. You might be able to look into your online banking in the settings, in the mortgage summary section of your particular bank, and you may see it there. But you're looking for a very specific date. That date is when your fixed rate mortgage is going to expire. That means that the very next day, your interest rate is going to jump. It will go through the roof. You want to start preparing now. And if you don't know how to do it, scroll on back to where we discussed how people that are about to experience can prepare, and start to follow those steps as well. Because you also are in a position where you can actually get ahead of this, and you don't want it to impact you. So say you call up the bank and you discover your fixed rate expires in 6 months' time. The bank may offer to fix your interest rate now for another 2 years. Should you actually accept that offer? Well, my advice, and obviously this is general advice, if you want specific advice, get in touch with us. My advice would be to leave it until you're closer to your fixed rate expiring, because right now you have a super low interest rate. And if that fixed interest rate is super low, you should be really focusing on improving your budget, improving your buffer, not touching that fixed rate until it's just about to expire. And that's where I say, get in touch with a broker about 2 months before that fixed rate expires and have a chat to them about putting a plan in place. I would say if the bank is offering to fix your interest rate for another X amount of years and it's going to currently expire in 6 months or more, the answer is no. You don't want to have that. In terms of whether you want to fix it once it comes out of that fixed rate period and you want to refix it, at that point, you really want to actually look at what all of the different options are for you and see whether there's actually a better option, because refixing that interest rate may be a great option for you, but it also might not be. So to recap, you should know what a mortgage cliff is now. If not, I haven't done my job very well and I'm very sorry. Go back to the video, rewatch it again. Hopefully, re-listening to it a couple of times will explain it quite clearly to you. That's terrible and that's offensive. I shouldn't say that. So you now know what a mortgage cliff is. You know how to prepare for it if it's coming for you. You know how to find out if it's coming for you. And we've got some strategies in place to help you better deal with your finances day to day all around this mortgage cliff. Hope you enjoyed this video, found it helpful, and give it a share, give it a like, give it a subscribe, all of those things. They help the algorithm and they help us to know that we're actually providing useful content for you to be able to improve your financial situation using the tips and strategies that we've used to help our clients save millions of dollars off their mortgages and in their businesses and their lives.